This conference will now be recorded.
So good evening to all. It's a Saturday evening. Warm welcome to Dr. Punita. It's an honor, madam, to have you here. And also Mr. Aditya, welcome to you. Thanks, InCred, for a great association we have started. I'm sure as the time progresses, it's only going to blossom into greater cooperations. Thank you very much for all the attendees who are here. All protocols observed. Thank you, Munishji, for coming for this particular meeting, and Dhirenji, and our own Sanjay ji is also here. Thank you very much for all your presence. So to start with, let me just give a brief idea about PIOCCI, because PIOCCI is a very important organization, and overall it has been in the forefront of taking care of people of Indian origin worldwide. Just to give you a brief idea, People of Indian Origin Chamber of Commerce and Industries is a global business platform working closely with reputed entrepreneurs and Indian diaspora to promote investment and international trade opportunities. PIOCC is helping people of Indian origin, non-resident Indians and their business enterprises of all sizes to operate and explore new dimensions on building economic partnership both internationally and in India. We provide vital connection between PIOs, government and business. Our unparalleled reach and deep understanding of the Indian ecosystem places us to penetrate the challenges faced by Indian diaspora, from owning micro enterprises to large companies. We deliver solutions and services that combines a global perspective and local expertise, and one core purpose to promote innovation, scale and inclusive growth. PIOCC collaborates with Indian diaspora with regard to exploring, helping, orienting, hand-holding and setting up businesses in different states of India, acting as a single point of contact for all business needs of overseas Indians. Yeah. Sanjay ji, welcome.
Yeah, namaste. Good evening, everyone. Apology, there was a technical glitch and I was not able to see all of you.
Okay.
So good to see
Sanjay
you
ji,
all. Welcome,
yeah.
Munish ji. Welcome, Vikram ji, and all our team from Nigeria as well as India and US. We have some teammates from UK also.
Thank you, Sanjay ji.
We all know that today's webinar is through PIOCCI, that is People of Indian Origin Chamber of Commerce and Industries. And here in Nigeria, we have a good base of professionals, expatriates who are working here as well as who are into the business. And with this opportunity, we are trying to connect with our motherland as well as the technology we have throughout with the global Indians. From Nigeria, I can see we have representative like our Vice President Dharendra Chauhan, General Secretary Mr. Venkat Subramaniam, who is the coordinator for today. I can see Mr. Santi Bhushan and so many. So we are there, and let's continue. Thank you for the time and opportunity to be present on a trade and development efforts of Indians, which is the soft skill of all Indians internationally, connecting each other and doing our best for betterment of everyone. Thank you.
Thanks, Sanjay ji. Thank you very much. For giving an overview of PIOCCI. Now, of course, let me introduce Mr. Munish Gupta as well, our guest of honor. He is a media personality, promoter of PIO TV, and have various ventures in electronic media in USA and India. He is a General Secretary of Foreign Correspondents Club of India at New Delhi and Vice President of PIOCCI. Special envoy to promote trade and business with Rwanda. Mr. Munish, I wish you could give us, and more oversight about PIOCCI. Thank you, sir.
Great. Well, thank you. First of all, our special guests, And thank you, Sanjay and Venkat, for inviting me. I have come here at very short notice,
Okay, Bijay.
but it's good to be with all of you. Um, let me just explain one, the concept and the actual working functioning of PIO Chamber of Commerce and Industry. As earlier mentioned by Sanjay and by Venkat, it stands for the people of Indian origin. And I think that everybody gathered here is a person of Indian origin. So this movement started, PIO Chamber of Commerce and Industry started about 17 years ago in 2003, after the Pravasi Divas was launched by the government of India to conjugate the persons of Indian origin or NRIs with India, culturally and otherwise. So the chamber is registered. It has a headquarter in New Delhi, India, and we have a full secretariat that functions. We are not a mom and pop chamber as you see sometimes in different parts of the world by the Indian community. We decided that we wanted to be a very professional organization. So we have professional staff that works for us. We have a real space and conference areas in New Delhi. We sit in the prime location in New Delhi, right next to the BJP headquarters and in front of the Comptroller and Auditor General of India. Uh, the core team in India consists of accomplished persons. Some of them are people of Indian origin, but some of them are people from India. And the reason being that, as PIO Chamber of Commerce and Industry, we decided that we wanted to do two important things as a hub and spoke model. One is to establish chapters, excuse me, across the world, like this very robust, very vibrant chapter that you see in Nigeria. But we have chapters in about 50 countries that we have established so far around the world. But to connect them with India, we needed not only a headquarter in India, but also presence in the various states of India. Because when you come to do a project in a country like India, you actually have to do it not in New Delhi with the central government, but work in the states in different locations. So over a period of time, we have been able to build about 20 chapters in India in different states and union territories. So we believe that somebody who comes looking for an opportunity should not only be shown sort of just the way and by symbolism, but we can very practically handhold them and bring them to India and find them the connect if they need with the government and more importantly with the private sector in India, because all of us who belong to PIO Chamber of Commerce and Industry are from different industries, different sectors, and a lot of us are very accomplished. We also believe that as PIO Chamber of Commerce and Industry, we must focus on the small and medium sector, micro, small and medium sector, because in our experience, the large companies know how to do their own business very well, and they like to do it independently. And they typically, even if they have positions at other chambers of commerce, which are the very big visible ones in different countries, then it's more of a sort of title they want to carry. They still do their business in their own way themselves directly and don't really use the Chamber of Commerce. So we are focused on connecting the SMEs of India with the SMEs in the diaspora world. We also believe, and we have seen some practical examples of how the Indian diaspora, which has created a very strong base and foundation for itself in the different countries where they now live and have become very influential and affluent and excelled in their sectors, are also able to connect and conjugate India with the mainstream business community. I'm sure that all of you have partners of some sort or the other, with non-Indians. And this is how the government of India and even we otherwise feel that we are able to bring in partnerships which are not just Indian. The other the other belief that we've had and we are working on this is that as we bring people from different countries, PIOs from different countries, and connect them with India, it also gives an opportunity for PIOs from different countries and different parts of the world to connect with each other and do business, trade, investment between themselves and their countries. So this is another great area that we feel that we push. And the government of India has actually seen us in action for a very long time. Some of us independently and individually are very well known in government circles because of what we do. Either, my background is personally media, but there are other people from different sectors and walks of life, and the government knows us well, and we've done very well in our businesses, and we've also also connected already India with our parts of the world. So they see that that ability in us, and the government of India actually works with us very, very closely. I wanted to also share with you that on 10th of January this year, before all this COVID thing happened, on 10th of January, the government of India officially, which is the Ministry of External Affairs and the Ministry of Commerce and Industry, with PIO Chamber of Commerce and in the presence of the Industry and Commerce Minister, which is Mr. Piyush Goyal, and all of us, we launched what is called the PIO Investor Help Desk, which is a joint collaborative effort by the two ministries, which represent the government of India. So Ministry of Commerce and Industry is represented by a very beautiful institution, which I know for a long time. It's called Invest India. And Invest India represents the government of India and will connect us to any and every ministry that we need to get connected to. And Ministry of External Affairs, because we are all external to India, is the gatekeeper. So they work with us. So in effect, what we have done is that any query of any PIO wanting to do anything in India that's to do with trade or commerce or investment of any kind will be taken care of at this one nodal point, and they can send the query to us. We can send it directly through Invest India. So this effort is something that we are building. In the last 3 months, also during 4 months since COVID, we have had many successful webinars, one with the Ministry of External Affairs and Invest India, rather two of them, where they have explained that pathway and are growing it with us. And one more piece of good news is that we've just had a great interaction I've had with the Ministry of External Affairs, and India is preparing for the next Pravasi Bharatiya Divas, which is supposed to happen in January of 2021. But most likely it will be a virtual event, or at best a little bit of a hybrid with maybe 50, 100 people that they really call to India, and the rest would be all online. And PIO Chamber of Commerce and Industry will play a very important role together with the government on several conferences leading up to Pravasi Divas, even prior to that, on the economic engagement between the Indian diaspora and India. A lot of us also, like me, are very important members in different committees of chambers of commerce. Like I particularly deal with FICCI in India. So I sit on the startup committee and science and technology committee and R&D committee. My background before I came into media is science and technology. So I've never sort of left that. But I deal with a lot of sectors. Africa, as Venkat mentioned and Sanjay mentioned, is of particular interest to me. I've been traveling through Africa for the last 20 years, and I started creating India's bilateral technology transfer with Rwanda, and now it's expanded to Ethiopia after the first successful pilot. Rather, this morning, together with the government of India, FICCI, and United Nations, and USAID and DFID, we celebrated the South-South Cooperation Day, marking India's very big entry into Africa through these two programs, Rwanda and Ethiopia. And we are sector agnostic. That's the same thing we want to do with PIO Chamber of Commerce and Industry. So that's, I guess, enough of an introduction. I mean, I'll be very happy later to answer any questions, I'm sure, being late in the night. We want to hear our important speakers and let them have the floor now. Thank you, everyone. Thanks, Venkat.
Thank you, Manuji. Thank you very much. I really appreciate it. Thank you. So now let me start by introducing InCred Wealth and InCred Asset Management Company, who have really tried very hard to bring this particular platform today. I'm really thankful to them for all the support they have extended. To give a brief idea about the company, InCred Wealth is a fast-growing wealth management company based out of Mumbai, India. As a company, they have successfully built their foundation through and despite the lockdown, bolstered by InCred Group strength in retail lending, asset management, and investment banking. InCred Wealth has already gained a strong reputation for being very interesting domestic as well as global investment opportunities to our Indian clientele globally. InCred Asset Management Company is going to further strengthen the position of the InCred Group by offering differentiated investment strategies for investors and Indian healthcare in one such opportunity at this stage. Now let me take this honor and opportunity for introducing our keynote speaker, our main speaker, Dr. Punita Kumar Sinha. Madam, welcome. Dr. Punita is a chairperson, InCred AMC, and brings more than 30 years of experience in investment management and financial market. She is also the founder and managing partner, Pacific Paradigm Advisors, an independent investment advisory and management firm focused on Asia. Punita is a senior advisor and serves as an independent director for several companies, among which is also Lupin, a leading Indian pharmaceutical company. She is also on the board of Chartered Financial Analyst Institute, where she chairs the investment committee and is a member of Research Foundation Board of Trustees. Punita spearheads some of the first foreign investments in Indian equity market in early 1990s. Prior to founding Pacific Paradigm Advisors, she was a senior managing director of Blackstone and chief investment officer of Blackstone Asia Advisors. Dr. Kumar Sinha was also the senior portfolio manager and CIO for the India Fund, the largest India fund in the US for almost 15 years, the Asia Tiger Fund and the Asia Opportunity Fund. Madam, welcome to PIOCCI.
Thank you very much. In fact, I'm a PIO myself, so it's interesting to be speaking to other PIOs.
Thank you, madam. Thank you. So before I make Mr. Aditya the presenter, let me also introduce our guest speaker who is in our midst, and he is Mr. Aditya Khemka. Aditya has recently joined InCred AMC as fund manager for the healthcare and pharma sector, which is going to be the focus area of today's discussion as well. Formerly, Aditya has worked with DSP investment manager and is well known as a top performing healthcare fund manager in India. Under Aditya, the DSP healthcare fund generated a return of over 65% over the last 12 months and 30% since inception, and makes it the best performing sectoral fund in pharma healthcare. He has worked across the world, including in the US, European Union, Latin America, and in India. He started his career working with Glenmark Pharma in 2005, worked in Brazil and Argentina. He then moved to Lehman Brothers, US in 2007 and covered US generic companies like Teva, Mylan, etc. He then worked with Nomura UK in 2008, covering multinational companies, pharma companies like GSK, Novartis, Sanofi, among others. Moving to Nomura India in 2000, where he started coverage of Indian healthcare sector. So, Mr. Aditya, welcome to PIOCCI platform.
Thank you, InCred. Thanks for the introduction.
Yeah, thank you. I will make you the presenter so that you can start presenting. Madam, I think the time has come when you have to share your presentation so that we can be put through the the global scenario today.
Sure. So what I was, the way we have structured our discussion today, first, thank you very much, all of you, for coming on a Saturday evening to listen to us. So we appreciate the opportunity to share our views. And what I was thinking of doing is I will discuss with you what the global trends are right now on the macro and markets and financial, financial markets, valuations, etc. And then we get, since I believe many of you are from the healthcare industry, we thought we should also talk to you about why we believe this is such a great space to be in, and why we are launching a dedicated fund. And Aditya will take you through the thesis of what's happening in the pharmaceutical industry and why this fund makes a lot of sense as well. So Aditya, if you could just go on to the first page of the presentation. If you could just move on to that. So you all know that COVID is still a big concern, and this shows you the cumulative numbers. India is now just about overtaking Brazil as a number 2 in number of COVID cases. Not a great ranking to have. US still, of course, outnumbers India, but US, the number of new cases is now flattening, whereas in India, as the economy is opened up and there are no more real lockdowns, the cases are actually rising quite substantially. However, the mortality rates are not as bad as they are in the developed markets, but still this is something to watch as the year progresses. Moving on to the next page, despite COVID and despite all the concerns that we've seen with the lockdowns and the impact on the economies, what has really surprised is that markets have recovered sharply since March. Markets fell very, very sharply, as you know, in March, and there was a lot of concern on what was going to happen to the global economy and trade. But the financial markets have recovered a lot. And of course, US has been one of the best performing markets. And even in the US, NASDAQ has been the best performing market. So it's really the US technology sector that has done extremely well. Of course, one of the reasons is that technology has become even more important during the COVID era and the work from home. So a lot of technology companies have benefited from that trend. But even so, with the largest number of cases in the world, US still has done very well in terms of stock market performance. It's done better than most, other than China. So China, the ironic thing is that COVID has had very little impact on the stock market performance. I mean, the whole thing started from China, but the Chinese market hasn't really been impacted negatively. US has had a lot of cases, but the US markets haven't really been impacted negatively, or whatever impact was there, it has been since the March recovery in the markets, all of that loss has been wiped out. We'll go to the next page. This also just shows the different asset classes. And as you can see, NASDAQ has been the best performing. And then all the growth and momentum stocks have done really well. And then after the US is China. And then some of the bond markets have done well as well. India has been somewhere in the middle. I mean, MSCI India is still down for the year to date in dollar terms, partly also because we've also had the rupee weakening. But even in absolute rupee terms, the index is still down year to date, but not by anywhere close to what it was in March. And the only country where the COVID and the stock market seem to be on the same trajectory is Brazil, where the number of cases were very high as a number 2, but the stock market is also reflecting a very sharp correction, and that market has continued to underperform. We'll move on to the next page. So we wanted to show you here what's happening to fund flows. And obviously, a lot of investors have moved towards gold and have raised cash in their portfolios in March. There were very few brave investors that actually bought into the correction in March because there was a lot of uncertainty. And as you can see that the money market funds, this was in July, even as of July, they had about 23.9% allocation from investors. And then the next biggest allocation was high yield funds. So people did move from equities to money market, cash, gold, and ETFs. In India, on the right, we've shown you what the mutual funds have been doing. So the mutual funds were having consistently, we were seeing inflows. And then we saw very sharp outflows in March. And then after that, we've started seeing inflows again, but they're, not of the same magnitude, but they're still, investors are still putting money into the markets. And only in August, we've seen a little bit of outflows. So the trend hasn't really been to total flight to safety. So mutual fund investors are still, or rather retail investors are still coming into mutual funds. And foreign portfolio investors, which is institutional investors outside of India, while they did for a period of time in March and April and June, we did see declining flows. Those flows have now come back. So as value emerged, we started seeing foreign institutional investors come back into the Indian markets. And so the flows are back. There doesn't seem to be as much fear yet, given what's happening in COVID. And I think everybody thinks the worst is behind. So let's keep taking you through some of more data to show you where we stand. So Aditya, next page. So here we wanted to just show you what has happened to markets in the previous crisis. So in 1992, where the Indian economy had its crisis. In 1997, the dot-com bust. In 2000, 1997, sorry, was the Asian crisis. 2000 was the dot-com bust. I've lived through all of them, actually all of them, because I started my career before 1992. Then 2008 financial crisis. In all of those, the markets fell anywhere from 58% to 38%, and the average of that was 50%. In 2020, the markets didn't fall anywhere close to what we saw in the dot-com bust or in the global financial crisis of 2008. And while in the past, the recovery has taken time, almost about a year on average, in 2020, this year, we pretty much recovered all those losses in 5 months or so. So from March to now, I mean, we've pretty much wiped out all the losses. And as you can see in the chart below, whether it is for the Nifty or for the S&P 500, there's been a very sharp recovery since March end. So markets, S&P is up 49% and the Nifty is up 51% from the bottom. So what we were showing you in terms of flows, a lot of those people who came into the markets in March, April, May, and were brave enough, obviously, have gained from this upside. So moving on to the next page, and this is happening in the backdrop of global growth projections still being downgraded. So earlier in the year, the IMF had a positive growth for the world output at 3.3% for 2020 and 3.4% for 2021. In April, after the corona crisis hit, they downgraded 2020 to -3% and 2021 to 5.8%. In June, they further downgraded 2020 to -4.9% for the world output. And for India too, we've seen the same kind of declining trend. I actually think, and this data is of June, but I expect further downgrades. And even if you look at firms like Goldman Sachs and others, Morgan Stanley, I think they think that 2020 we could have -10% growth for India in terms of global economic growth, GDP. So we're going to have a very sharp, and this is probably in first time in 40 years where India's actually had a negative growth of this magnitude. So it is quite significant that in 40 years, India has not seen such a sharp decline. So the impact of the lockdowns, the corona crisis, has definitely taken a toll on the economy. But of course, what the expectation is that 2021, things will normalize and things will become better, and India is going to go back to its normalized growth rate of 6 to 7%. And we'll show you some information that shows where things are right now in terms of normalizing. Aditya, if we could just move to the next page. So as I said, global macro indicators are beginning to normalize despite the GDP growth forecast for 2020. So 2020, we're anyway into September. So the year is pretty much half done for India's fiscal year, and for most other countries, we are into the last quarter almost of the year. But if you look at the PMI trend, most countries, as you can probably see from this chart, the blue line, the dark blue line is India. And from March 2019 to now, we are pretty much, we are about almost 80% of the way recovered back. So March and April, India PMI took a really big hit, but it has recovered quite nicely after that. And as of August, we are, the PMI is, just slightly below what it was in 2019. And if you look at the country-wise unemployment trend too, well, unemployment, as you can see, in March rose very sharply across the world, and a lot of jobs were lost. Now that trend has also come down. So people are coming back to work. People have started hiring people. When I speak to a lot of the companies that I'm on the board of that are in the manufacturing sector, they had a lot of issues with the migrant labor having left. But from what they're seeing now is that 80% of the migrant labor is actually back to work now. So the unemployment trends are not looking quite as bad. Of course, they're not at the, we're still not back to the unemployment levels prior to COVID at 2019 levels. In 2017, of course, India's unemployment rates were much lower. So we've seen as low as like less than 5%, but on average 5 to 6% unemployment. And now that number is over 10%, but it went up to as much as 20%. And this is more obviously the formal economy, but in the informal economy also, a lot of people in the small and medium enterprises, businesses have, some businesses, particularly in sectors such as travel, tourism, anything related to hotels. So all of that has shut down, and a lot of contract labor is probably not fully captured in this, but slowly and surely people are getting back to work, and we hope that this isn't going to be a permanent damage. In fact, even right now, even if you look at a city like Delhi, a lot of people don't have help because their drivers left, and some people laid off their drivers. But now slowly, as offices have opened, people are looking to rehire, and they're calling back their staff. So things will take some time to normalize, but it's already not as bad as what it was at the lockdown. So we keep moving, Aditya. And if you look at the monthly IIP data, that shows minus 57.6 in April, and now it's minus 10. So that is showing a very nice V-shaped recovery on the IIP data. We're still below our normal levels, but we are, not as bad as we could have been, and things have recovered. The other positive factor for India has obviously been the correction in the crude prices. And crude, as you know, India is a big importer. And so the correction in the crude prices have also helped to some extent on the fiscal side. And if crude prices remain low, as the world demand still remains low, then that should offset some of the hits that we're taking on the fiscal side. Moving on to the next page. So one of the reasons why the recovery has been very sharp, and it's still not fully at normal levels, but things have normalized, is that the governments have been very proactive in providing stimulus packages. So while Corona hasn't yet been addressed and we haven't found a vaccine, and the economies are not going to operate at 100%, the fact is that the governments have been proactively giving stimulus packages to weather the storm and to ease the pain for the average person. And on the left, we've shown, India has given about 10.3% of its GDP as fiscal stimulus, and a lot of it is being provided to the vulnerable, the migrants, urban and rural poor, MSMEs, agri sector, and then of course the RBI has also supported by providing a lot of liquidity and loans and moratoriums to customers of banks and NBFCs. So the government has, India has never had a lot of money compared to the US. And one of the reasons the US markets have also done, if you look and see what the markets that have done the best are the ones that where the governments have a lot more money. So India is not, the governments have never had a lot of room to, in their fiscal to really provide a lot of stimulus, but US and China do have a lot more money, and they have really given much bigger stimulus packages. So, I mean, if you look at US, for a population that is, 1/3 of or less even of India, the per capita stimulus is significantly higher because of the GDP. It's 10.7%, but the GDP itself is much, much higher than of India. Germany has given a very big stimulus, and India somewhere in the middle. So again, when you look at the stock market performance, countries like US, Germany, the markets have done relatively better as well. India somewhere in the middle. But for India, that is quite a bit of stimulus. Over to the next page. And as I mentioned, the RBI has provided tremendous amount of stimulus. In fact, our bond yields now are at 20-year lows. And that has also, for companies who have taken a lot of debt, for customers who are leveraged, it has given some relief. And it is continuing to give some relief as companies are refinancing their debt and trying to improve their cash flows. So that has really helped. And of course, US, we are at like 0% interest rates. And so, this cheap money is fueling a lot of M&A, is fueling a lot of, companies trying to use this opportunity to borrow cheaply and invest. In India, I'll go to the next page. Aditya. On this chart, I'm showing you capex and consumption in India. While interest rates are low, companies have been using this opportunity to refinance their debt and also raise and boost their capital levels, but haven't really started to do a lot of capex. So capex and consumption in India is still a risk because it is at 2001 levels, which is pretty dire for an economy that has to support 1.3 billion people. We need a lot more investment, we need a lot more capex, and we need consumption demand to help us take us out of this economic situation. And even the lower interest rates haven't yet brought that respite for companies. But slowly and steadily, things are a lot better. But I think this is a risk that still remains. While a lot of factors have resumed towards normal levels, until companies invest and grow, the economy is still going to, the government can only do so much. And one of the other concerns is because interest rates are so low, and this is something that is not just affecting India, I'm showing US, but it also in other countries, we are seeing these kind of indicators that inflation has begun to pick up, because there's been just tremendous amount of stimulus, and some of that is getting into inflating asset prices. There are some asset bubbles getting created across the world as well, and also the people who have the certain supplies constraints have also created disruption of supplies, and so inflation has begun to pick up. So, I mean, there is one scenario, a dire scenario that one should, with a low probability at this point, but that does still exist, is that we could have a long period of slow growth and higher inflation. That isn't going to be great for the world. But as of now, things are looking a lot better. So one is not really hoping for the scenario or to pan out, but something we have to keep an eye on. And then the other concern is, of course, that the fiscal accounts have deteriorated significantly across the world because countries have provided a lot of stimulus. And you can see that pre-COVID, what the fiscal situation was in most of the world, and what the situation is right now. So there is a lot of debt. There's a lot of paper that has been issued by governments, and that could also weigh on the global economy going forward. And of course, we have trade that has also gotten severely disrupted. Global trade is also at very low levels compared to what we've seen. Part of that is COVID, obviously, but part of it is also governments across the world are very conscious of the rising trend towards nationalism, and all countries want to localize their production and also rationalize their supply chains. So we are seeing that shift also affecting global trade. And while the global macro now is not as bad, it's looking relatively benign. There are some things obviously that we have to be aware of and be concerned about and keep an eye on, as I mentioned. One, of course, is the fiscal situation. Second is the geopolitical risks. And as you all know, India, China, that's something that is a rising concern. And US-China, that's another concern. So the role of China in the global economy, that itself could play a big role over the next decade, and how that changes dynamics. The presidential election in the US is coming up. That could, provide a very, under two different outcomes, and we don't know which of those two, and that could provide, that could either be a positive or a negative for the markets. The two candidates have very different policies, and they might approach the world very differently, and the stimulus as well very differently. So something, and taxes quite differently. So that's something we have to keep an eye on as well. So I think while things have are improving, we are not out of the woods totally, and there are some concerns that are lingering, and the future might look quite different than what it has looked in the last decade. Now, I just wanted to take you over now to what the financial markets have done. I think that we just move on to the. So here we're just showing you corporate profits and GDP. And India actually doesn't look too bad compared to the rest of the world. Of course, the countries that are looking best in terms of having both positive GDP and also, everybody's had a negative corporate profit in the second quarter. There isn't hardly, I think Sweden is like at 0, but every country is being below, and -10 to -70% profit declines, corporate profit declines. And of course, China, again, ironically, has the positive GDP growth of the second quarter and the least amount of corporate profit declines. And then Indonesia, Asia, Taiwan, etc., those countries are still well positioned. US has also had relatively lower profit decline at -20. India is kind of again in the middle, a -30% or so profit decline, and a GDP decline as well. A real GDP decline as well. And then when you look at the corporate profits year on year, again, India is somewhere in the middle, with China, Taiwan, again, doing relatively better. Now, if you break that corporate profit down by sector, again, and compare it to what we saw in the global financial shock in 2008, the global profits haven't declined actually as much as they declined in 2008, corporate profits. And there is, of course, a big variation in sectors, and healthcare, for which many of you represent that sector, and that's why we're going to talk about healthcare as well, has actually done the least. Almost IT and healthcare are the best performing. So healthcare did not see such a big drop in corporate profits and has been very resilient. In fact, has benefited quite significantly during this period, as everybody realizes that healthcare spend needs to improve. Energy, materials, and consumer discretionary, which includes travel and retail and malls, etc., movies, cinema, all of that has been hit very badly. That wasn't, of course, it's still consistent with what we saw in 2008. But those are the sectors also, when the economic recovery happens, that also benefit the fastest. Next chart. So in the wake of all of this concern, what you can see is that the US, the equity markets have done quite well. making valuations actually look quite high in the US. And as you can see, there have been no earnings upgrades in the S&P. While the economic data is improving slightly, nobody's upgraded. None of the analysts are upgrading their earnings estimates for the S&P. And the markets have kind of run ahead of the economic recovery. And so valuations are looking high. And I think we've seen over the last few days some correction in the markets. And I wouldn't be surprised if we see more volatility till the end of the year, because we have an election coming up in the US. We also, valuations are pricing in a very strong recovery for next year. And so any further shocks, any setback on the COVID situation could create more volatility for the markets. And if you look at what's happening in India, it's kind of the same situation. Aditya, next page. But not as things are, I mean, India hasn't recovered as much. Our valuations on last 12 months is looking high. But whether when you look at on price to book, certain sectors are still at trading at valuation lows. But this is only for the Nifty, which is just 50 stocks. So right now, whenever there's a crisis, there's flight to safety to some extent, and everybody's shifted to large caps. Only over the last 6-8 weeks, we've seen money go back to mid and small cap, where there is still some value. So we go to the next page. Aditya. So if you, the mid cap segment is still, the broader market is still not as, nowhere near bubble levels, nowhere near peaks. So there is room for more recovery there. And if you look at the, this is a complicated chart, unweighted to weighted index. Basically, it shows that any time that that ratio is at the level of where it is right now, 140 to 160, that the unweighted index, which is more the mid and small caps, do rally, and they've touched as much as 200 in terms of the ratio. There is, I still think there is mid and small cap, and the broader market in India does offer value. And of course, SEBI keeps coming up with new rules, and they've just come up with a new circular. I'm not sure what will actually, whether it'll be fully implemented or what, but it is now saying that all cap funds, mutual funds in India, have to allocate 25% to mid cap and 25% to small cap. And so there going to be a lot of reallocation happening from some funds who are mostly in large cap, and they'll have to reallocate to mid and small cap. So the money flow will also come towards this segment. And this is supportive of the fact, I mean, this is also being supported by the fact that valuations of this segment are a lot better. Aditya, I think there's one more chart. So while India is continuing to trade at a premium to other countries, we've always done so in the past. So I wouldn't be concerned about that. I would focus on being much more selective on the kinds of companies that one picks in this environment, because there is value in certain companies, certain sectors, and stock picking is going to be very, very important. It is even whether it's the US market, global markets, India, broad, the market indices are not cheap, but there are stocks that still remain very attractive. And I think we could over time see a shift into some of these cyclical sectors, some of the consumer discretionary, where valuations are still looking attractive. But healthcare obviously remains a very resilient sector, and it is not a sector that is just a cyclical. It's going to be secular, given that there is a pandemic and people are afraid that there could be another pandemic and a worse one coming, or other waves coming. So I think health, and also the shifting away from China to other countries for supply of various APIs and other chemicals is also going to be a beneficiary for countries that can supply those kinds of products. And at this point, I think it makes sense for me to shift over to Aditya Khemka to talk about the healthcare sector and why he thinks it's attractive and what he likes in that sector. Thank you.
Sure. Hi, everyone, and thanks, Punita, for
Thank you.
the address. Um, just okay. Yeah. So I guess Venkat did a great job of giving my introduction, so I'm not going to sort of repeat that. But just one liner. Up till until my last job, I was working with DSP Mutual Fund, managing the DSP Healthcare Fund till yesterday, and I've joined InCred now, so working with InCred now. Moving on to the sector and some of the nuances of the sector. So I often face this question from many participants, why should we invest in healthcare and why Indian healthcare to be more specific? So my thoughts in 5 bullet points. One, India is the pharmacy of the world. We have to realize and everybody has to acknowledge the fact that, when it comes to end dosage, finished product production, India not only offers a very decent quality product, it offers that quality product at a very, very decent cost. And when you have global markets and global governments working on healthcare costs, reducing pharmaceutical cost, a country like India is just your white knight, right? I mean, you can provide generics and reduce the cost of your patients while doing so. India as a pharmaceutical market has been growing rapidly over the last decade. It's a double-digit growth that the country has consistently clocked over the last decade. And I don't think that's going anywhere given the changes that we have seen in lifestyle, changes that we are seeing in food habits, and also the demographics of the country, right? Slightly younger population now beginning to age. So you will see that sort of continuing to fuel India pharmaceutical market growth. Just as a data point at this point, US is a total of 350 million people. It's a $500 billion market in terms of the pharmaceutical market. India is 1.3 billion people and only a 17 or 18 billion dollar market. So India is 20% of the world population and 2% of the world pharma market. US is 5% of the world population and 50% of the world pharma market. So that gives you a sense of what sort of a runway for growth we have in front of us. Also the fact that you have to realize what leads to incremental pharmaceutical consumption, and that is basically high per capita income. So initially people, is this what we have observed over the past as a trend, that people first spend on housing, they spend on food, they spend on housing, food, and then the third item that they get to spend on is actually health. So given that India is going up that curve in terms of GDP growth, per capita income growth, the impetus to healthcare will just increase, and COVID is just a catalyst in that journey. It has just increased that pace of focus of the population. Outside of US, India has the highest amount of US FDA approved facilities, that again is sort of a testament to our low cost production ability, which is again driven by a low labor cost. And why is the labor cost low? Simply because of the supply. We have 1.5 million engineers graduating every year in India versus 0.2 million engineers graduating in US. So you just have a higher supply. And as a country, as a culture, our history has been extremely great in terms of medicine. Atharva Veda is the first known medical book in the world, and it was authored here in India at 1200 BC. Black magic was something that was, I believe, invented in India, and it was nothing but evidence of chemistry, which is the core of pharmaceuticals. So yeah. Now let me talk to you briefly about the performance of the healthcare segment in India versus the broader healthcare market. I'll first talk to you about the performance, then I'll talk to you about why this happened, and then we will all put together, take probably a call on what can happen next, right? So we will distill the facts from the opinions. So these are facts, and then we will talk about the opinions. So fact is that FY10 to FY15, the BSE Healthcare Index outperformed the Nifty, which is a broader benchmark, for each and every year. So you can see the level of outperformance. Some years it was 30% like FY10, and in other years it was 45% like FY15. So, pretty stark outperformance. And then from FY16 to 19, something changed. And we will talk a lot about what changed. But something definitely changed. You saw the healthcare index underperforming the broader market each and every year for the next 4 years. So it was, underperformance was 24% in FY18, it was 18% in FY17, and so on. Now, for the last 2 years, FY20 to 21, that outperformance has just started again. So, FY20 was just a 10% outperformance. FY21 so far has been great. So it has been a 20% outperformance. And, so these are facts. Now, when I talk to you more, I'll probably give you my opinion as to, what will happen next. And are we entering like a 4-5 year trajectory of outperformance for healthcare again? I mean, that's something we will discuss. Now, even before I get into what led to that outperformance or underperformance, I know we have an audience which is quite adept at the pharmaceutical business. So I'll just give you my perspective of what an average Indian pharma company does, right? So if you guys focus on the first quadrant here, so the average Indian pharmaceutical company, let's say, does 100 rupees of revenue at a consolidated level. The way it's divided is that they sell 30 rupees in India, they sell 50 rupees worth of goods in US, and they sell 20 rupees worth of goods in rest of the world, emerging markets, or even APIs, which are essentially raw materials for pharmaceutical products. And that's the case, right? So, and then if you look at the profitability of these three businesses separately, so an average Indian company today makes about a 40% EBITDA margin in the India business. In the US business, the EBITDA margins on an average are about 10%. And in the API business is about 25%. So that's the EBITDA they do. All in all, if I take it down to the return on equity, an average Indian company does between 40 and 50% return on equity in the domestic Indian business. They make a loss, a very, very narrow loss, but they make a loss in their US business, and that brings their ROE to negative 10%, 12%. And on the API and ROW segment, they do a moderate return on equity, a very stable return on equity of 15 to 16%. But when you look at the consolidated number, what you see is that they do ROE of 10%. Now, the biggest culprit here, obviously, is the US business. The business has the highest amount of capital employed. 50 out of 100 rupees is employed in US, and it gives you a loss. So, your overall return on equity is significantly compromised because of what happens in the US segment of your business. Now, what I've done in this infographic is I've just taken the same example in the third quadrant, and I've just removed the US business, right? So the way we value stocks today in India, most of the analysts, what they write, they say that, look, this company is doing 9.5 rupees of EPS, 100 rupees of capital employed, 10% return on equity. So why don't we value it almost at 20 times, given it's a pharma company, and you get a target price, or you get a stock price of about 190 rupees. Where my view differ from most of those analysts is the following infographic, the third quadrant, where I say, let us ignore the US business for now. Let us not look at the US business. Let us look at the company excluding the US business for now. And why am I doing that? I'll talk about that later. But just if I look at the same infographic without the US business, the revenue from 100 goes to 50, but the EBITDA from 22 goes to 17. Your capital employed goes down from 100 to 50, and your return on equity goes up from 10 to 31%. Now, if I ask an analyst today in India to value this company, the company in the third quadrant without the US business, he would at least give this company a 25 times multiple because it's a significantly high ROE business. He can also go out and give a higher multiple, but I am saying a very conservative multiple of 25 times. And he will look at the EPS of 15.5 rupees, and the stock price that you get is almost double, more than double, as in the previous example. Now, why do I take this approach? This approach is important because in the first approach, when you are valuing the 9.5 rupees at 20 times to arrive at 190 rupees, what you're basically doing is you're giving the loss of the US a multiple. This minus 6 rupees in US business, that gets a multiple. Now, the moment you give a loss a multiple, mathematically what you are telling me, or mathematically what you are implying in your valuations, is that not only will the loss remain a loss, the loss will actually grow as a loss for the next 20 years, which means that if today the loss is 6 rupees, next year the loss will be 7 rupees, the next year the loss will be 8 rupees, so on and so forth. Now, to my mind, any rational businessman, any rational entrepreneurs, they will never do a business which they know will give them losses for 20 years and the losses will continue to grow, right? There is no end of the day, everybody does a business to make profits. So if the entrepreneur or the businessman is doing the business, the idea is either he will make profit, or if he doesn't make profit in the next 2, 3, 4 years, at some juncture, he will realize that he cannot make profit due to whatever reason, and he will close the business down. So if he closes the business down, the third quadrant valuation, the stock basically doubles, right? From 190 to 380, because there is no US business anymore. Sunk cost is sunk cost. On a going basis, there is, on a future basis, there is no further investment, or there's no further losses coming from that business, right? The stock price doubles. If the entrepreneur was right in the first place to have this business, then the stock price appreciation will be even higher, because this minus 6 rupees will one day become plus 6 rupees, right? He has employed 50 rupees of capital employed. At a 12% opportunity cost of capital, he should actually get about 6 rupees of profit. Now, if I add that 6 rupees of profit in the third infographic, your 15.5 rupees of EPS goes to 21.5, and your stock can actually go to about a 500 rupee level, north of 500, which is actually closer to 2.5 to 3 times the current market price of the stock. So that's where I feel, people have gotten really distracted in the domestic pharma sector while they look at companies, because the US business has this overpowering impact on the capital employed, on the revenue. There is the overall consolidated statements of many of these pharma companies today are extremely distorted, and people are valuing the distorted consolidated statement at distorted valuations, and therefore they don't understand the underlying economics of the business. So just to summarize this slide, giving a zero value to a loss-making business will give us double the stock price today. If you give it a positive value because the promoter has invested and probably will make it profitable at some point in future, we are looking at even a higher upside. Now let me talk to you about what happened between FY9 to 15. Why did pharma stocks go up in that period? What led to that? And then we'll talk about the next phase, which was the decline of the pharma sector. So the first quadrant to your left top, you see the exposed to the US business. The growth rate from FY9 to 15 was 18%, compounded annual growth rate. Now that was significant growth. More importantly, the volume growth at this stage was only about 10 to 12%, and the price growth was 5 to 6%, which led to your overall compounded growth of 18%. Now, while you are selling more volumes, if you are able to take price increases, that really boosts your profitability, right? Because you have better asset turns, because you are selling more quantity, and you have higher margins because you are getting higher prices. Now that was really a very good period for pharmaceutical industry. On the other hand, to the second quadrant, you have the domestic Indian business, which is basically like an FMCG business. This is a business where you're allowed to brand your products. So for instance, if a person in India goes to the doctor with a fever, the doctor prescribes crocin or prescribes Calpol. He's not prescribing paracetamol, he's prescribing the brand, not a molecule. So when the patient goes to the pharmacy with the prescription, he's buying crocin or Calpol, he isn't really buying paracetamol. And let's say the same patient 1 year down the road gets a fever again, he may not even choose to go to the doctor. He may still just go to the pharmacy and again repeat purchase a crocin or a Calpol, because last time he got well when he took that, that medicine. So that in India creates that branding in India creates a significant barrier to entry for competition, creates significant favorable economics for the pharmaceutical producers and marketers, and it creates significant patient and doctor loyalty. And which is why you see such high margins in India, which you haven't seen in US ever. So, therefore, this business is actually more or less like a FMCG business in India, where the branding drives the sales, where the branding drives your competitive moat, where the branding drives the profitability and the volume growth and even price growth in many occasions. So India in that FY9 to 15 case actually grew at a 12% CAGR, which is quite a secular nature of our market. We keep growing between 8 and 12% year to year. Also, what happened was that the return on equity, I'm talking about the third quadrant here, the return on equity of the BSE Healthcare Index. At the beginning of 2009, actually the adjusted return on equity was closer to 9 to 10%. And there were some one-offs for some of the larger pharma companies, which is why the index return on equity looks higher than what I'm saying. But if you adjust it for the one-offs, it would be closer to 9 or 10%. And that return on equity, as the market, as the prices in US went up, as the volumes went up, that return on equity went up. And if you again just focus on the 10% return on equity back in 2009, just imagine 50% or 60% of your balance sheet is in the US business, giving you whatever returns, and 30% of your balance sheet is in the India business, giving you 60% return on equity. So if 30% of your balance sheet is giving you 50 or 60% of the return on equity, yet your consolidated return on equity is 10%, which means the other part of your balance sheet, which is the US business, is actually giving you a low single-digit loss, right? Which is how your weighted average will come to a 10%, correct? And that is where, these pharmaceutical companies started taking price increases. You cannot be loss making forever, right? At some stage, you will have to arrive at profitability. And those price increases, those volume growths led to the improvement of adjusted ROE from 10% in 2009 to about 25-26% in 2015. Now that was further compounded by a re-rating of the valuations in the sector. So the sector to begin with in 2009 was about 2.5 times price to book and 3 times price to book, and it went up to 6 to 7 times price to book by 2015. Now this is a double bonanza, right? You have earnings growth and you have re-rating of the sector. The investors made a lot of money, but they made a very crucial error. What was the crucial error they made? They were giving very, very high valuations to a business like the US business, which basically has no branding. It is a commodity business. There is no differentiation. If a patient goes to the US pharmacy with a prescription, the prescription says paracetamol. It does not say crocin or calpol. And basically generics cannot brand themselves in the US. And therefore, whether it's a Dr. Reddy's paracetamol, or it's a Sun Pharma paracetamol, or it's a Lupin paracetamol, the product which sells is the product which has the lowest cost, not the best brand equity, but the lowest cost. And therefore, the US market behaves like a commodity market for pharma companies, where the lowest cost producer is most important. Because if you have the lowest cost, you have the lowest price. If you have the lowest price, you can actually sell the most, because there is no differentiation between your product and the next guy. So what the mistake that investors make back in 2015 was to give a very high multiple to a business which included the branding part of India, but that was a smaller part. But on the larger part, it was a US business which had no competitive moat. And what happens when you make very high returns in a competitive business, right? So 2015, if the ROE is 27% for the consolidated business and India is still giving you 50% return on equity, then your US business is actually giving you more like 20% return on equity, right? Now, if you're making more than 20% return on equity in a commodity business, what happens next? You attract competition, you attract supply. And then what happens when supply comes in? Collapsing of prices. So FY15 to 19 in the US business, we saw top line growth of 8%, but the volume growth was 13-14%, and there was an average price decline of 6 to 7%. Now, price declines devastate your bottom line because they go straight from your margins, whereas the Indian pharma market was still growing at 9 or 10% CAGR, again secular, almost an FMCG type of business. But because price declines happened so sharply in US, your 26-27% return on equity of 2015 by 2019 had come back to 10%. And again, if you look at 2019, you're looking at 10% consolidated return on equity. If you divide it between India and US, India again is giving you about 50% return on equity, whereas the US has already started giving you losses, which is the first infographic we discussed, right? US was giving losses in FY19, in 2019. And why investors lost so much wealth? Because along with destruction of return on equity, there was a destruction of the multiple as well. Again, a mistake if you ask me, because again, see, if you're valuing a commodity business, right, a commodity business will keep fluctuating between bottom end of pricing to the higher end of pricing. And as you go to the higher end of pricing, you should actually give it a lower multiple to compensate for the fact that you're currently in an supernormal trajectory of profitability, and you will revert to mean at some time. And similarly, when you go to the bottom end of the pricing cycle, you should increase the multiple. So to adjust for the fact that you're currently making abnormally low profits, but you will revert to mean, and therefore your stock price needs to adjust for that dynamic. And people do that in sectors like cement, steel. I've seen stock prices behave in that fashion, multiples behave in that fashion, But somehow in pharma, that correlation doesn't exist. Maybe because people don't understand the commodity nature of the US business. So what happened back in 2019 was the same mistake that investors made in 2015. In 2015, we gave supernormal profits a supernormal high multiple. In 2019 end, we were giving a supernormally low multiple to a supernormally low profit. And what followed is, we all know. So not only did the pricing recover in US, the drug shortages went up, domestic business continued to grow. And we have seen, if you look at the last chart at the bottom right, we have just in Jan to March 20, we have just seen an uptick in the return on equity for the sector. And that small minor uptick has resulted in like a 30-40% rally in the pharma index. This is basically a chart showing you the US revenue of certain companies. So people tell me, pharma has recovered because of COVID. COVID has impacted, the sector, and therefore investors are favoring the sector. I say you are missing the big picture. Pharmaceutical revenues for the US market actually started improving about a year back, about a year before COVID ever came. So if you look at some of these companies, this is their US revenue for the past 6-7 quarters, and if you look at them, most of them had recovered from their lows in 2Q19 and were actually started growing way before COVID actually came in. So I think people just missed that bus. And what COVID actually did is COVID forced the investors to look at these numbers and start realizing that the sector had already started recovering from its lows. Now, these are two very interesting charts, and I know I'll get a lot of questions on valuation, so I want to address a couple upfront. So first is the EV/EBITDA chart for the BSE Healthcare Index versus the broader market, which is the Nifty. So if you look at the orange line, that is the EV/EBITDA number on the left-hand axis, and the premium discount is the gray line to the right-hand axis. So on an average over the 10-year period, the healthcare index has traded at a 40% premium to the broader market. Now that premium, obviously in 2015, when people were giving high multiples to high profits, had gone to about 100% premium. And in 2019, when people were again making the same mistake that they made in 2009 of giving low multiples to low profits, that premium had actually gone to a discount of a low single-digit percentage point. Or maybe no discount, but a no premium situation. And from there, we have recovered now after the rally that we have seen in pharma sector in India for the last 6 months. We have now come back to the 10-year average. So by no stretch of imagination are we expensive today. We are at the mean of the last 10 years. We are not at a discount anymore, yes, but we are in no sense are we at a premium to our own averages. The same picture gets reflected on the right-hand chart, which is the price to book. So, historically, pharma sector, again, a 40% premium to the broader market on price to book. And as we see, the peak was 140% premium. And today we are at a 40% premium, which is the 10-year average. So we are not expensive by any stretch of imagination. Now, if you look at business cycles, I just want to sort of focus here a bit. So if you look at where we were in 2015, we were on the second quadrant, the right top quadrant, where the valuations were high and the business cycle was at its top. Now that's the recipe for disaster. From there, you can only lose money. It's a matter of time before you start losing money from there. Where we were in 2019, we were at the left bottom quadrant, low valuation and bottom of the business cycle. Where are we today? So we are on the average valuation. So this dotted circle, that is where we are today. We are at the average of the valuation, but we are still at the bottom of the business cycle. Our ROEs, which had touched 9% in 2019, has recovered only to 10.5% in 2020. So we haven't really gone back to 25-26% ROE yet. So our business cycle is still pretty much at the bottom. Valuation numbers no longer at the bottom, but at a 10-year average, but way away from the higher end of the valuations that we have seen in the past. I just want to bust a myth in pharma, and many people have questioned me on this, but I want to put this point out forward. And generally, large cap investing, why large cap investing is popular, why large cap investing is favored by most passive investors in the world. They say large caps are safe. Large caps mean safety, blue chips, and so on and so forth. There are various rationales that one can give you to explain that logic. In my view, in pharma, it just doesn't work. And I've just given you one example there, but there are thousands of examples that we could have discussed. So back in 2015, I pegged the stock price of Sun Pharma and IPCA both at 100 rupees. Today, that stock price so if it was 100 for Sun Pharma in 2015, today it's closer to 50, 60 rupees. And for IPCA, if it was 100 in 2016, today it's about 400 rupees. IPCA is about 1/6 the size of Sun Pharma in terms of revenue. And if you look at the financial metrics, so something like a Sun Pharma, the revenue CAGR FY16 to 20 last 5 years has been 4%. For IPCA has been 12. EBITDA CAGR for Sun Pharma has been negative. For IPCA has been 30. PAT CAGR for Sun Pharma has been -5. For IPCA has been 63. And the ROEs for Sun Pharma, which was 17% back in 2016, are now at 9%. And for IPCA, the ROE, which was 4% in 2016, is now at 18%. Why this is more important is because in pharma, because these companies are conglomerates, they have that domestic FMCG business, and then they have the export commodity business. One has to understand the mix of the cash flow. The size of your cash flow will never tell you how sustainable it is. It cannot tell you that. You have to look at the mix of the cash flow, the quality of the cash flow. If the quality of the cash flow is good, even if the absolute amount is low, it deserves a higher multiple. And if the quality of the cash flow is low, even if the absolute amount is high, which it was for Sun Pharma back in 2015, it doesn't deserve a high multiple because it's not sustainable, because it's coming from commodity where there will be competition because you're making high profits in a commodity business with no differentiation. Some of the other wealth creating opportunities that keep emerging in pharma. So I'm sure there will be questions on US FDA issues, but I look at it as an opportunity. Back in DSP, we have many of these stocks where we have made money after they got into US FDA problem, simply because a US FDA problem is a temporary issue, but the stock price as it falls in line with the earning estimate for the next year. But the earning estimate for next year is impacted way more than the earning estimate, let's say, of the 4th or 5th year because of a US FDA problem. So I always look at these, accidents for these pharma companies as wealth making opportunities. One such example was Divi's Labs. When they got an issue in 2017, the stock declined 50% and went up 100% after the issue was resolved. It's just a mathematical equation, isn't it? I mean, if a 100 rupee stock goes to 50, the decline is 50. But if the 50 rupee stock goes to 100, the increase is 100%. So your entry point matters a lot in some of these situations. Next example, that of Alembic Pharma, companies which have very high investments in the US and are not making money today. A majority of our Indian pharma companies are today in this situation where Alembic was back in 2011. So they had invested a lot in the domestic business, in the export business, and from 2011 their export business started getting monetized, and from 2011 to 15 you can see the way the market cap went up, and they started in then 2015 they started a fresh round of investments in exports. Now when you make investments, the costs are upfront and the revenues are back-ended, the cash flows are back-ended, and that impacts your stock prices because investors are just looking at next 6 months or 12 months. Nobody wants to take a 4 or 5 year call. But if they were to take a 4 or 5 year call, they realize that there would come a time when these costs will get matching revenues on the P&L. And when that happens, your stock price again will start going up. So that is what we have seen for Alembic now. So today Alembic is twice the market cap that this chart shows. So as they started monetizing their exports, again the stock has rallied. So clearly, some things that investors haven't done very well in the past. Companies that scale up the value chain, another example being Divi's Labs itself, cheap manufacturer, small product basket, very large scale, huge barrier to entry, very strong IP protection around its business. That has simply shown great growth in the past, and I think this is here to stay. This trend is here to stay. Just to give you a data point on something like a Divi's Lab, and I'm sure again I'll get questions on this entire China migration demand from China to India in terms of pharmaceutical capacity. So Divi's is a 40-year-old company. If you open their annual report for 2019, their total gross block was about 2,600 crore Indian rupees, and their capital expenditure in FY20 and FY21 put together is going to be about 2,000 crore Indian rupees. So they are going to spend almost as much they've spent in the past 35 years in the next 2 years in terms of capital expenditure. That's the kind of demand these companies are facing. They just cannot have enough capacity to cater. And then they have issues with environmental clearance or land acquisition, which are significant problems of doing business in India. But they're tackling those issues as they're going along. And yeah, I mean, the demand side of the equation is beautifully poised today. It's only about the supply for these companies. How fast are they able to build facilities? How quickly are they able to get regulatory approvals? And how soon can they start supplying the product? And the last investment making opportunities, like businesses like Sanofi India, these are companies that don't do the export business, do only the domestic business, and therefore they're in true fabric of the business, sort of a FMCG fabric of their business, because they do not have that high cash guzzling machine of the US business or that commodity nature of investments. So they will always show very consistent growth in their profitability, and that consistency gets rewarded by investors over time in terms of a higher multiple and a consistent return on their stock prices. This is just a slide on the recent PLI scheme, the production linked incentive scheme that the government of India had. I'll come back to this slide if you have any questions. The summary of this slide is that the government has made a lot of noise around this, the production linked incentive schemes for pharmaceutical products, but from the industry's perspective is not really very meaningful. The size of the incentive scheme is too small. In fact, the recent withdrawal of MEIS scheme in India will actually hurt this industry somewhat in the near term rather than benefit this industry. So yeah, I mean, government is replacing something great that they had with something really very mediocre. And I don't look at this entire PLI scheme as a big boon to the entire sector. But yeah, what this scheme tells me is that the government's intent is in the right place and they're starting to take action. So as a government, I think the Indian government has always been good with intent. Execution is something which we have really not been very good at. And this PLI scheme at least gives me some thought about the Indian government trying to act beyond just thinking. So that's all I would take away from the PLI scheme. So other than the pharma business, the businesses which are like in India, you have hospitals and diagnostics. These are part of the broader ecosystem. And Ayushman Bharat in India has been a great initiative, I think, by the government of India. Very well executed, very well planned. I think there are still some things they have to change. But if you just think about it, government of India talking about 10 crore families getting insurance of 5 lakh rupees each. The average size of a family in India is 4.5 people. So you're looking at about 45 crore Indians getting medical insurance. And these people were basically people who are not able to afford any form of healthcare earlier. So, the kind of demand that you're going to see to come to the private sector, simply because India, 70% of the healthcare infrastructure belongs to the government. Yet 80% of the Indian population goes to the private hospitals. And the reason being the difference in the standard of care between the public institution and a private institution in India. And I think that's here to stay. So I think Ayushman Bharat is a great initiative, but that will not lead patients to go to public institutions. Patients will still go to private institutions. And which is where these listed companies like, maybe in Apollos or Fortises or the Max Indias of the world, they will make a good amount of money because, hospital business is a business of operating leverage. Whether you have 5 patients in your hospital or 100 patients in your hospital, the AC needs to be working, the doctors need to be there, the nurses need to be there. So the cost of serving 5 patients is very similar to the cost of serving 100 patients, but the revenue is totally different. So, you need to sort of see that operating leverage playing out in the hospital companies in India. And I think Ayushman Bharat will be instrumental there. Same goes for the diagnostic chains, other than the fact that government doesn't have its own diagnostic infrastructure. They do have their own hospital infrastructure, but they do not have any dedicated diagnostic chains. So diagnostic chains in India are doing fantastically well, 15% volume growth every year. The market itself is growing at 10%, and the private market is obviously gaining share from the unorganized market. So, the unorganized market is about 85%, and the private market is, organized market is 15%. So they are gaining share, and, they are growing much faster. And pharma companies will also benefit because if there are more patients to the hospitals, more patients to the diagnostics, then those patients will end up taking pharmaceutical products eventually. So just to give you a magnitude here, today, if I speak to an Apollo hospitals, they tell me that out of the 130 crore Indians that exist today, only about 20 crore or 25 crore Indians can afford any form of healthcare. And Ayushman Bharat at its peak will increase that 20-25 crores to 60-70 crores. Now that peak can come 5 years down the road or 10 years down the road. It doesn't really matter. It depends on the execution behind the program from the government of India. But regardless, if your volume growth is like 2.5x, be it in 5 years or 10 years, is going to lead to a huge amount of operating leverage and huge amount of capacity utilization. which ends up resulting in better return on equities, better cash flows, and eventually better stock prices and better returns for the investors. This is a slide purely based on just to give you a sense of how underpenetrated and unserved the Indian healthcare market is. I'm going to skip it in the interest of time. Similar slide for the diagnostic industry. So, extremely unorganized, very regional as of now, but branding is getting a lot of importance here, and therefore the bigger brands like Dr. Lal, Metropolis, SRL, Thyrocare, they are becoming more and more relevant in the current environment. Still very regional play diagnostics. So each of these big brands are trying to increase their geographical footprint to grow in terms of brand, to grow in terms of patients, to grow in terms of volumes. And that's really what's driving the shift from unorganized to organized in diagnostics. Yeah, very underpenetrated market. Still, patients in India are very reactive still. So 91 to 93% of the patients who go to diagnostic labs go with a prescription, which means they are coming to the diagnostic lab because a doctor asked them to come to the diagnostic lab. And only 7 to 9% of Indian patients actually voluntarily go for a diagnostic test. Now, that same statistic in US would be north of 30-40%. So more than 30-40% patients who walk into a diagnostic lab are patients who have themselves come for a checkup. No doctor has asked them to do a checkup. It's just that they weren't feeling well and they thought they would check it out. So, there's a huge amount of healthcare awareness, which Indians are gaining in these times, but that awareness will result in more walk-ins from patients. Significant room for growth. Number of diagnostic labs per million in US is 418. In India is 39. Even in another emerging market like Brazil is 60. So we are still way behind our emerging market peers, also let alone our developed market peers like US. I'll just briefly touch upon my investment framework and philosophy. I think, very simple philosophy that I follow. I want to identify good quality businesses. I want to assess managements regarding their honesty and their competency. They should be honest and competent. I don't really like overpaying for businesses. I like to buy businesses at fair value because we are actually in the game of generating returns. And if you buy something by paying an exorbitant price, the return that you can potentially realize from that is just so much lower. So, you want to buy stocks below or at their fair value, but not beyond their fair value. And in terms of portfolio allocation, I'd like to diversify a portfolio, although high conviction bets, high size bets will always be there, but you want to be diversified across different business models. And, you can always allocate a higher weight depending on your conviction. So, and depending on the risk. So, some of the businesses will have some inherent risk always. And you account for the risk by the weight that you assign to the stock. So if you think the risk is too high, you assign a lower weight. If you still like the business and the valuation, you assign it a lower weight. If you think the risk is low and you like the business and you like the valuation, you just assign it a higher weight. And the last point is the toughest thing to do, in my view, in portfolio management. That is the low churn. So the two portfolios that I managed in my past, the first portfolio had a churn ratio of 5%, which means my average holding period of a stock was 20 years. And the second portfolio that I managed had an average churn ratio of 13%, which means my average holding period of a stock was about 8 years. So I don't like to churn the portfolio unless my thesis has gone wrong. And if the thesis has gone wrong, I'm very happy to churn it and change the position. But if it hasn't, I am more of a patient investor from that perspective. The investment framework, how I identify companies, how I identify companies that I would like to invest in. So these are some very quantitative measures that we use. First is economic value added. So we look at the 5-year return on equity that the company has generated, and we ideally like that 5-year average return on equity to be equal or higher than the cost of capital of the company. Even if the current cost of capital is lower than current return on equity is lower than cost of capital, we should have reason to believe that the ROE will improve going forward. Execution track record, we like to see 3 years, 5 years, 10 years growth rates, and that should be more than 8%, or at least what the represented market grew at, if not 8%. And then, there are temporary disruptions in the sector because of US FDA, because of regulatory issues. So, we do pardon some companies for that. And, if some companies have faced some of these temporary distress situations, we are okay to look at those companies even if they don't meet the above criteria. Managements, we judge managements on various things, including some very quantitative criteria like CFO to EBITDA, cash flow from operations to EBITDA, their merger and acquisition track record, their corporate governance history. Cannot stress enough how important this is, related party transactions, and intercorporate deposits. Lastly, margin of safety. We are in the business of generating returns, so we don't like to overpay. We like to be very disciplined in our buying behavior. So what has helped me to generate alpha in the past 5 years that I've managed money? I think bottom-up research, obviously. So, the first infographic that we saw, which business is doing what for which company, and therefore what is the trajectory of the other business that the company is doing, understanding the dynamics, what are the valuation gaps, and understanding the valuation gap and taking a high conviction call where the gap is significant. Taking huge amount of active risk in the portfolio. So my portfolio management style is not a benchmark hugging style. I'm fairly away from the benchmark in most of my portfolios, 40% commonality to the benchmark. Most of my peers were between 70 to 90% common to the benchmark. And I was only 40% common, which resulted in a good outcome, and we will come to the outcome later, but it was a good outcome. Average holding period I've already discussed, 8 to 10 years. And avoiding losses, I think margin of safety helps me a lot in avoiding losses, and that always has been something that I've gone by. Impact of COVID-19, I think we have discussed. It has just accelerated the trend of people paying more attention to their health. I think that's broadly what I'm summarizing in this slide. What are the risks in the sector? What can go wrong? Obviously, whenever you look at any investment thesis, always pay attention to the risk. Competition. So because a part of our business, the export business to US and European markets, that is because it's an unbranded business, that business is always vulnerable to competition. But competition comes at the peak of the profitability, not at the bottom. So keep that in mind. But yes, competition will always be a risk. Exchange rates, net, most pharma companies are exporters. So exchange rates matter a lot. The cost is primarily in Indian rupees, the revenue primarily in euros and dollars and sterling. So, you have to sort of keep that in mind. And regulatory headwinds, right? So politicians love pharma and the US FDA loves Indian companies. I'm sure we'll discuss that in the Q&A session. But yeah, so that's a risk that always lingers on the head of pharmaceuticals. Just to summarize my presentation to you, I know I've overshot my time, apologies. But the sector did very well from FY9 to 15, did very poorly from 15 to 19. That's basically a commodity pricing cycle. 9 to 15, commodity pricing up cycle in US, 15 to 19 down cycle. And FY20 onwards, we have seen improvement in the pricing cycle in US. India business has always been very secularly growing. It always grew in double digits in the past, continues to grow in high single digit to low double digits. And that should continue to drive the cash flows of these companies. We have witnessed a growth in base business in the US for most companies in the past 2-3 quarters. So the business cycle has definitely turned. Valuations, we are still at a 10-year average. We have come off the bottom, but we're still at a 10-year average. In terms of the business cycle, we are at the bottom still. So valuation at the average, not at the bottom, not at the peak, but business cycle still at the bottom. So that's broadly my presentation. Now, this is the track record of the fund that I was managing. The orange line is the DSP Healthcare Fund. The gray line is our second best performing fund on the street, other than us, other than DSP. The light blue line is the average of all the pharma funds on the street. And the last line, the bottom line, is the index, pharma index. So one of the reasons why we are able to generate that kind of alpha over the index was the high active risk that I spoke of, and also the low churn. I think these two are very, very key to the way I manage the portfolio. Also some numbers around that. So DSP Healthcare Fund, I'll leave these numbers to you. I don't think past performance is any indication of future, but just to sort of give you what the fund did while I was managing it. Yeah, that's pretty much from me. Take it away for questions, and more than happy to answer any of your queries. Over to you, Mr. Venkat.
Thank you. Thank you very much. It was a very elaborate presentation. It was really good. And is something, if you keep on going through the same presentation, lot of things will come. Most often, we have seen in presentation people only giving the main features, but you have almost taken us with the presentation in such a way that you wanted us to really understand what is pharma sector of India, what is the right way of investment. And in fact, to be very frank, many of the people here currently in the group, they have a lot of knowledge about the investment and other things. When it comes to me, I am personally not, very. I think I'm somebody who doesn't have much idea about this. But when you are explaining this to me, it's making even me understand that how important this sector is and how can we go ahead and invest in that. Thank you, Madam Punita ji. Thank you very much for your beautiful presentation. I know that it is almost close to 11 o'clock in India, if I'm not wrong. And in spite of that, the efforts you have taken to really, communicate to the audience in Nigeria. For us, it is much easier because it's around 7 o'clock today. I must really appreciate. Thank you, Mr. Aditya, for a beautiful presentation. Being Saturday evening, it's also a very complicated time for us. Most probably we would have really been, many people would have joined if it would have been on Sunday. But anyhow, all said done, we have some very big names, in Nigeria who are associated currently in this webinar. And I'm very sure that they would also be keen to asking some questions. One of the questions has been put forward by one of our, attendees. I will want Mr. Praveen Kumarji. Are you there? Praveenji, are you there? Praveenji, are you there?
Yes, I am here. I am listening you.
Yeah, sir, you had a question. Can you please put forward the question? Praveenji.
Yeah, my question was, what are the status and investment prospects of the African healthcare sector?
Yeah. Madam.
I would turn that over to Aditya because I don't know much about the African healthcare sector.
Yeah. So, hi Praveen, thanks for the question.
We are living in Africa and we are very much interested for the African economy and African market. Actually, India, yes, of course, India is a very beautiful country and we can see the all opportunity there. But as part of our living status here since long, we are looking forward for the African economy.
Understood, Praveen. So, Praveen, my limited understanding of the African market is that Africa is basically multiple countries in one. Like you have developed parts of Africa, like South Africa, and then you have really, economically difficult nations like Northern Africa. So, in the Northern African segment, I think Indian pharma companies are doing extremely well because WHO and other NGOs of the world are putting a lot of aid towards the African countries, and Indian companies are actually partnering with most of these African countries, African NGOs to provide medicines at a very, very reasonable price and cost, and sometimes even free. So, that's how the Indian pharma industries are participating in Africa. South Africa obviously is a great market to be in, and very few Indian pharma companies have been able to make good revenues there. But for the domestic African countries, pharma companies, my limited perspective is that barring maybe an Aspen or a couple of other stocks which are there, I struggle to remember all the names, but Aspen I remember very clearly is doing very well in Africa. But other companies, I don't see anything significantly large happening for them in Africa, simply because they're competing with Indian companies and they don't have the same cost advantage there. But to that extent, the African government is actually trying to push a reform where they're asking Indian companies to open facilities in Africa if they want to supply for the African market. So the African governments are trying to make local manufacturing compulsory for Indian companies if they want to supply to government tenders. And that's something that if it happens, then it can generate a lot of employment for Africa, and it can also probably reduce the cost arbitrage for the Indian pharma companies versus an African pharma company. Versus the African pharma company. Yeah. So I think overall, I don't see a huge investment opportunity in African pharma companies. But if these regulations change the rules of the game, like this cost arbitrage that India faces versus Africa, then maybe there may be something interesting there.
Yeah, thank you, Aditya.
Thank you, Aditya.
Thank you, Praveenji. Thank you very much for your question. Mr. Dhirendra Chauhan wants to ask a question. Dhirendraji.
Yeah, hi Aditya, thanks for the beautiful presentation. My question is that this pharma sector has already grown more than 30%, or let's say on an average 40% since March, almost a V-shaped recovery. So do you think this still have some potential left in coming 6 months to 1 year?
Yeah, absolutely. So Dhiren, actually I touched upon this a couple of times during my presentation. So the best time to invest in a sector, or best time to invest in the pharma sector, is when the ROEs are closer to 9-10%, right? Because at that time, a 9-10% ROE tells you that the domestic business is giving you 40-50%, but the export business is giving you 0% or -2% ROE, and that's clearly not sustainable, right? So that time was a year back. Today, domestic is giving you 40-50%, export is giving you 2 or 3% return on equity. So if you look at from a business momentum perspective, nothing has changed significantly in the past 1 year. Okay, what has changed is the stock price, and the stock price change has come because of multiples. So 1 year earlier, we were at the bottom of the pricing range for the last 10 years. Today, we are at the 10-year average. So, even now, the time to invest in pharma is really good because you're still at the 10-year average valuation and you're still at the bottom of the pricing, bottom of the business cycle. So, as the business cycle improves from here, your earning growth will drive your stock performance, and you're still way away from your peak valuations. So if that improvement in return on equity, that earning growth keeps coming year after year after year, most investors will have no choice but to re-rate the sector even further up from the 10-year average. So, that's how I look at pharma playing out for the next 10 years or next 5 years. So I think it's still a very good time. Also, there in this point, I actually mentioned this in my presentation. This 30-40% return from the bottom now, it's very optical. Okay, so something like a Sun Pharma going from 1200 to 300 is a 80% decline in stock price, right? But from 300 to 400 is a 35% increase in stock price, right? But if you take that in context that it was 1200 once and it is 400 now, that 35% rally behind you doesn't really make so much of a difference.
Yeah, thank you very much, Aditya. I have one more extended question associated with the same. The question is that, November is not far and the US is going to face the election, presidential election. And all companies, pharma companies are quite affected with US's performance here, and we know all that. So how do you think this election is going to affect our companies in India because of USDA?
Yeah, so that's a very interesting question, Dhiren, and I always get this question. I actually, if somebody doesn't ask this question, I ask this question to myself. So, see, basically, if you look at the US rhetoric currently around pharmaceutical products, they have made two very different points which cannot go together. One, the administration is saying make in America. Now, the cost of manufacturing in America is 50, 60, 70% higher than the cost of manufacturing the same thing in India in terms of the pharmaceutical product. And second, they're saying drug prices are too high, right? Now, you can address one of the two problems. You cannot address both problems, correct? Because if you want lower cost, then you have to stay with India. Or if you want make in America, then you have to pay more. You cannot have both, right? So the problem there is that every time before elections, be it Obama, be it Bush, be it Trump, every time before election, because pharmaceutical is a sector which is so close to the population's heart, they always come out with these executive orders and propose legislations and draft legislations. Trump did that 4 years back also when he came into power. But once he comes into power, the noise just dies. So it's more propaganda, it's more agenda, it's more of an election noise that we hear every time. And we see very little action after the election. So I don't think anything is going to change. See, Dhiren, keep in mind, the competitive advantage that the Indian pharma industry have is global. There is no other sector in India where we can call ourselves globally competitive. We are not. Maruti cannot sell products across the globe. HDFC Bank cannot get retail accounts across the globe. This is a sector where we sell products even to China. I mean, we import everything from China, but pharmaceutical product is a product that we sell even to China, the finished dosage. So this is a sector where we are globally competitive. And, you know, all these rhetorics and noise and, you know, these things will keep coming and going. These only create opportunities for investors like me to buy stocks at a more reasonable price. I don't see them as things that can change their investment thesis.
Thank you very much, Aditya. I must say this has been last 2 hours has been most enlightening in terms of stock markets and especially the pharma sector and the future of Indian equity. Thank you very much.
Thanks, Dhiren. Thanks for the compliment.
Yeah, Munishji, you wanted to ask a question.
I just wanted, I just very quickly just wanted Aditya to answer. I mean, what about biotech? You're focusing on traditional pharma sector. What about biotech?
Right. So biotech has a very, very long runway for growth, Munishji, right? It's a modern therapeutic, correct? More targeted therapy, safer, more efficacious. But in India, as of now, you know, we don't have companies which are creating novel biotech solutions. Yes, there are a couple of companies like Glenmark and Biocon which are trying to invent biologic products. But other than that, you know, companies like Biocon trying to make biosimilars. And biosimilars is a story which has an uncharted trajectory ahead of it. So, you know, it is a venture which can generate supernormal profits. It is a venture which can generate very poor ROEs. I'm not sure which way it will go. But, you know, if I look at the stock prices, then the stock prices tell me that they know it will go very well. So that is something I can't really, you know, have in my, I can't really digest as an investment idea. Because if there is uncertainty in the business, I want to see that uncertainty reflected in the price as well. It doesn't reflect in the price in my view today, but it reflects in the business. So which is why I'll watch this space very carefully. It's a very interesting space, no doubt. And biosimilars are going to be very interesting to watch. But novel biologic engineering, that is something that only a very handful of companies are doing. They haven't succeeded yet. But when they do, it will be very big. So yeah, we'll watch that space very, very keenly.
Thank you, Mr. Aditya.
One more follow up on that. Where do you think India's R&D in the pharma sector is going? I mean, you know, Western companies are very big on R&D, and that's how they control the big market, the big drugs, the new drugs.
Yeah.
I mean, India traditionally does not pay attention as much, at least not the private sector, on R&D. So what's R&D do? What's pharma sector doing in R&D?
So India historically, Munish, has been a generic manufacturer. So we do R&D a lot actually, and you'll be surprised we actually do more R&D than a Pfizer or a J&J does. If you look at as a percentage of revenue, absolute numbers we can't match; those are multi-billion-dollar enterprises, right? But if I look at percentage of revenue, there are many companies in India which spend more in R&D than the Lillys and the Pfizers of the world. But yeah. So R&D skills in India are more, I would say, efficient and more renowned in the chemistry space. We are very good with chemical engineering. We are the best in the world with chemical engineering. Nobody can hold our hand in that space. Biologics is something I think we are more of a challenger than a front runner. I think the front runner in biologics is China and US to a very large extent. We are not clearly the leaders in biologics. So which is where my skepticism around biosimilars and novel biologics is there, but I'll be happy to prove wrong here. I mean, things evolve, and we are a country which has great talent. So I'll be very, very happy to see India do well in biologics. It's just that we don't have a track record.
Yeah, thanks Aditya for this beautiful point, because being in pharma, we really know that India is really doing extremely well in pharmaceutical segment. Thank you very much. Santosh Kumar, you on the microphone. Do you wish to ask any question, Santosh? Mr. Santosh Kumar?
No, thanks a lot, Venkat. No, I did not want to ask. It was by error I unmuted, but I was enthralled by the content that was given by Aditya. I regret that I have dialed in so late. Looks like I have missed a great session. I'm so sorry about it. In fact, I'm sorry for myself. But Aditya, I'm really enthralled by the content and the insights that you are providing. I'm so happy for that. Thank you so much.
Thanks,
Thank you so much.
Thanks for the
Dr. Punita, I have a question. It is going in my mind, and I have been, wanting to know when it comes to investment. In our mind, is about investing in gold, investing in land. For us, investing in shares or something is not something which is very common. Because we come from a family which has always been taught either you invest in land or you invest in gold. And suddenly, some of the points are proving to be right because suddenly the gold prices have increased. And my family has been asking me buy gold, and I have restricted. Now they say, see, now the prices are very high. So I don't know how far it is going to go. So I'm curious to ask this question from you. So can you please throw some light, which is the right place to invest currently? Because it's very uncertain future now.
Well, I mean, see, gold and land are investments that don't offer any easy liquidity. And so, I mean, when we recommend to clients, we always recommend that they should have a mix of assets and be diversified between illiquid and liquid assets. Financial assets are more liquid, and the volatility is more visible because you can trade them. But even gold prices have only recovered now. If you go back a long period of time, gold prices haven't really done anything until over just the last couple of years. So I think it's always good to be diversified, not just across different asset classes between equities, bonds, gold, real estate. Even within equities, you should be diversified between global and country specific, sector specific. So I think that is always a more prudent way, and it also depends on betting on gold only and land. I mean, is also I think risky because whenever there's volatility, gold does well, but gold doesn't do well in all economic environments. But gold does do well in certain inflationary environments and certain periods of crises. But if economic growth is doing really well and the markets are in not pricing in a lot of risk, at that point, gold underperforms.
Okay, thank you, madam. And Mr. Aditya, I have one question for you. We have been following up on all the pharmaceutical company worldwide. There was a time when I was doing a presentation, and I was able to look at that what is the value of business which India exports internationally. I found that in spite of the reason that we call ourselves the pharmacy of the world, maybe in terms of volume, but when it comes in terms of value, we are in probably of course China doesn't come anywhere, but we are in the 10th position. And when we look at the entire scenario, we see now that 65% of our imports in India for raw materials is coming actually from China. And looking at entire scenario, we find that countries like Germany, Switzerland, they are in the top 4 or 5. So why do you see that, is it that if you are pricing something more, then you probably are the higher league? If you're pricing low, you are at the lower league. In what way when you are asking people to invest, what is your criteria of, understanding this? I would like to know broadly about it.
Yeah, sure. So look, it depends on what you're exporting within pharmaceuticals, right? So India makes generics. And generics by definition will be high volume and low value. So just to give you a sense, right, I told you that the US market is $500 billion. Now that is the value of the market. Generic market is 60 billion in US, and the innovator market is 440 billion in US. That 60 billion value market is 90% volume market. And that 440 billion value market of innovators is only 10% volume market. So basically, the price of an innovator product can be about 70 to 500 times the price of a generic product, right?
Yes.
So if Sweden, Germany, Japan, they are selling innovator products, even if they sell 100th of the volume that we sell, value might be similar or more because their pricing is higher. And their patents is what they have on these products, and the patents allow you to charge a higher price because it makes it a monopoly. If you have a patent, it's a monopoly. So if the patient wants the drug, he wants the drug, he has to pay for it, right? So that's the difference. Volume-wise, nobody is even closer. So our market share in US in terms of volume is 47%. And 2009, that market share was 9%. So from 9% to 47% in a matter of 11 years. And it has been a vertical straight, it has been almost a linear straight line. So we have gained volume share every year. So, that's okay. I'm saying it doesn't matter to me whether we sell low value products or high value products. It doesn't matter to me how much volume we sell. What matters to me is what is the return on equity that I make on my invested capital. I am a businessman, Mr. Venkat. And if I am a businessman, if I have 100 rupees and I have invested 100 rupees, my thought would have been to at least make a 10 rupee profit every year out of that 100 rupees, because I am based out of India, where the fixed deposit rate is 7% or 6% today. But if I can get 6-7% in fixed deposit, and if I'm running a business, I want some premium. And that premium needs to be 3-4% at least. So 10% is my minimum required return on equity. Today, that business is giving me 0 or 2% return on equity. So something needs to change. Either I need to shut down the business and put that money in fixed deposit, or I need to make the business so profitable that it starts giving me a 10% return. I'm just an investor who's waiting for that to happen. That's all.
Thank you, Aditya. Mr. Kishan wants to ask a question. Kishan. Mr. Kishan, please unmute yourself.
Okay, good evening all. I just wanted to ask how important is in today's thing, because we have been receiving a lot of information or a lot of reports now that the US markets and other markets have performed better off than Indian markets. And also, if you look into actually the Sensex the contribution to the overall equity market across the globe, it is less than 2%. And in US, you name majority of the big names, they're all basically in US and other developed markets. So in today's context, how do you, what is your opinion rather on global investing as a part of one's portfolio? Thank you.
Okay. Yeah. No, as I mean, global investing is always what is recommended. I mean, US market is the largest market and is, the top economy in the world, and also the most accessible for investors. I mean, Chinese economy has also become very large, but it's not as accessible for everybody other than through Hong Kong shares. So that is why the US markets obviously are the most open also for investors, and everybody prefers to invest in the US. And if you look over the last 10 years, actually US markets have outperformed European markets. Europe hasn't done much of anything. In fact, US has been the best performing markets over the last decade. And however, having said that, valuations, as I showed in my presentation, are not cheap. And if you look at the rest of the world's valuations, equity market valuations are much more attractive as compared to the US. The US companies, of course, are also global in nature, right? So you are getting some global diversification when you invest in the US, because most US companies have operations now across the world. But the equity markets are somewhat correlated, not fully correlated. So we always recommend people should have other international non-US asset classes in their portfolio. Generally people put in about 10 to 20% in non-US equities, and emerging markets where India fits in is also recommended because they are for much more longer term growth. India obviously, while it's much smaller an economy, it also is growing faster, or has been growing faster than the developed markets at a 6-7% GDP. If it is able to recover to a 6-8% GDP growth over the next few years, it would become the fastest growing economy over the US. And while we have a long way to catch up, we have a lot of companies that are undervalued, and India has always needed capital. So, there are lots of companies that you can find which are attractively valued, but they come with more volatility and more risk. So if you're looking at a global portfolio, India wouldn't be a very large part of it, but India deserves a very decent amount of allocation from an emerging market portfolio.
Thank you, madam. Mr. Krishnan, I hope you got the clarity of the answer.
Yes, dear. Thank you, madam.
Thank you. Anybody else who wish to ask a question, please you can on your microphone and ask. Because it's already 7:35 now. Because according to that, I think in India it is close to 12 o'clock. And though I can see Dr. Punita madam and Aditya to be fresh as as if they have woken up early in the morning, but still I don't want this to continue. Yeah, Kalpesh ji, please. You want to ask something?
No, nothing. I'm just wanted to add. Yeah, it's well.
Yeah. Yeah, Kalpesh ji, you want to say something? Yeah. So, Munish ji, thank you very much for still staying with us now. Dhirendra ji, are you there? Mr. Dhirendra Chauhan?
Well, somebody asked a very important question now. They said, how can we contact InCred for investments? Now that's what you want to hear. Aditya, I think you want to respond to that one. I think on the message board, you might want to put out your at least email connect. And, for my part, I want to say that this has been a very exhaustive but interesting session, as most people have said. I think you brought in a lot of good market information, a lot of research and interesting thoughts. I would spar you, Mr. Khemka, on some of the healthcare investments that India can offer in the future. So if and when we meet in India, we'll talk about, because I deal with technology, just the technology side. I think the pharma sector has done incredibly well in India, and India should create the MNCs of the future in the pharma sector. And I think I liked what Mrs. Sinha just said, that these MNCs listed, particularly the listed companies, the big listed companies in the US stock exchanges benefit a lot from the fact that they are globally diversified. And I think the day the Indian business people learn that they must invest across the world and everywhere in the world to become the giants of tomorrow, like the Americans and the developed countries have become, then we'll have a huge whole lot of good portfolios to offer in different sectors. But I'm sure that health is just one of those sectors, that pharma is one of those subsectors that you wanted to focus on today. And I'm sure there's a lot of other meat and potatoes that you bring to the future webinars and information sessions. But thank you so much. I beg to now leave my good friends. This was very interesting, Venkat. Despite the last minute, I enjoyed it. I usually don't have, as a media person, I don't have an attention span of 2 hours. But I kind of stuck to it and found some valuable statistics. But I didn't catch any of it I didn't record any of it because it kept saying confidential. So I said, okay, leave the InCred confidentiality to them. But we'll
I have recording. I will share it with all, because we put it out to all the people.
Confidential information, and they put in a lot of hard work. Let it be theirs. I think it was good information for all of us to have. There have been some very, very good questions from the audience, and I'm sure that enthused both of you. I think we can also look forward to a larger audience when you deal with the larger PIOCCI. But these people, Sanjay and Venkat, have started a good trend with you, and we hope to carry that forward to the larger PIOCCI platform. And if you are interested, with Sanjay and Venkat can talk to you. But if you're interested in taking a position with us, as we further take a position with the Pravasi Divas now, and some of the big sessions that will happen with the global diaspora, where we expect thousands and thousands of people to attend virtually, more so because it's virtual this time. This will be the first time that Pravasi Bharatiya Divas will be actually virtual. and I think we'll probably get the biggest attendance of all. We've sometimes had 5,000-6,000 people, of which 3,000 are overseas Indians. But I think in the Pravasi Bharati Divas next year, it could well be 10,000 or more. So these are good platforms. This is good exposure for you. And it's good to see people like my friend from Boston and you from India. And I got also a very quick LinkedIn ad request from your managing partner also in Mumbai. I definitely have no problem adding everybody. So thank you again. Lovely. We'll catch up soon.
Thank you, Muniji. Thank you, Muniji. Yeah, Mr. Dhiren.
Thank you, sir. That would be me. So I just sent a very. Thank you so much, sir, for attending this. Thank you.
Thank you.
Yeah, Mr. Dhirendra, please. Can you please? Yeah, Kalpesh, you want to say something?
Sir, would you like to close, or Dhirendra sir will close? Would you like to close?
Yeah, Mr. Dhirendra will give the vote of thanks.
Yeah. Okay. Yeah. So I would like to thank Dr. Sinha for her time and the contribution, and our friend.
Hello.
Hello. Am I audible? Hello.
Yeah. You are.
Okay. So because the line is cracking here. Yeah. Okay. So Mr. Aditya, thank you very much for the wonderful presentation. This was really enlightening, and I'm sure all the audience had learned a lot, not only about the Indian equity market, but also how we can invest, and in this testing times, we can come up with some real support from finances. And I can assure you that from Nigeria, and not only from Nigeria, but the whole Africa, there is a lot of people going to contact your team for further investments, because we are going to take all the learnings from today's meeting forward to our PIOCCI platform across Africa. So thank you very, very much once again. And once again, thank you to our mentor and our guide, Sri Manish Gupta ji, for continuous support to us from PIOCCI platform. And I cannot close this meeting without saying a big thank you to our very own Mr. Venkat, the General Secretary, who has put his all efforts making this event as successful. Thank you very much. And we look forward to connecting with you and learning more and more and investing in India. Thank you very much.
Thank you so much, sir. Thank you so much, sir. There were a lot of key resolutions. I think the recording also will be very, very helpful. Thank you, Venkat sir, for giving us an opportunity, and we will be able to share this recording with all the other guys also that had registered. Thanks a lot. Thank you, Punita ma'am. Thanks a lot. Lot of inputs from your end. And thank you, Aditya. That was a very, very good presentation.
Thank you, Kalpesh.
Thank you.
Vikram and Kalpesh, you have really been very supportive. In fact, we would not have even thought of going to this far, but I would have expected at least 100+ audience as usual. But I don't know, maybe it is raining heavily today outside, and maybe that is why many people may not have connected. But we will share all this recording with everybody. Absolutely. And we will give you the feedback. Send you the email IDs of all the people who have attended. I think approximately 50 plus minus is there, because people, so we will send it across to you, so be in touch with you. And we will also seriously coordinate with you to see that how things can between both of us. Okay, thank you very much. Dr. Punita madam, thank you very much for your valuable time. I really appreciate your time. It was really a great honor to meet you. I have learned a lot. We will be in touch, and I'm sure there is something, we always meet for a purpose. Thank you very much.
Thank you.
And
thank you,
Mr. Aditya, thank you very much. Thank you. Aditya, thank you very much. It was really enlightening to have somebody who is so experienced and who can give us this idea. Thank you very much.
Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you to all the audience. Thank you to all the audience for staying 2+ hours. Thank you very much. We really appreciate your valuable time. So I can close the meeting?
Yes.
Yes.
Yeah, please. Thank you.
Thank you.